Welcome back, everybody. Doug Burson here again, and here we are at the end of day 2 at Tax Conference 2024. Pretty good day of classes, all in all. A little more heavy today, a lot of court cases and things of that nature. I'm not going to bog you guys down with that stuff. If you haven't watched part 1 from yesterday, I would suggest doing that first because this is a part of a series. So they're going to be 3 or 4 parts. We'll see how it goes, but it's all about the latest and greatest tax knowledge of this year so that when you get ready to prepare your taxes next year, you've got what you need. And if there's some things you need to do, we'll be going over some of that over the next few days as well. So with that being said, let's go ahead and get started. Okay, so like I said, we did some court case stuff today, and those can get pretty heavy and pretty detailed. But one thing that did come out that comes up, and usually by the time I know about it, it's too late. So I at least wanted to mention it here, was legal cases, especially involving physical injury. But as far as that goes, any kind of a settlement. So often I don't find out about this till we prepare the tax return. And at that point, it's too late. If you're going through one of these, it might make sense to at least get a little bit of tax counseling as well with the attorney to make sure that this thing is written in such a way that's going to help you, because so often I've seen where somebody gets what they think is a large settlement, and then the attorney gets their cut, and they didn't realize it was taxable. So then the IRS, because they're in a big tax bracket, the IRS takes their cut, the state takes their cut, and they're left going, what happened? I had this settlement, and I don't have anything left. So it's really important to at least think about those things, and that's what came out in one of these cases we were looking at today, is how important the language can be as far as on that physical injury especially, because generally those are not taxable settlements. But it's important that the language makes it clear so that we don't have a problem down the road. So if that's you, like I said, the tax cases get pretty difficult. Don't want to do that here. But if that's you, call your tax guy, call me if I'm your guy, and let's take a look at that and make sure you got what you need. Another thing that came up is IRA rollovers. A lot of people don't realize it, but they have 60 days to put that IRA back in. So in other words, let's say you took money out of your IRA, you needed to get it for a certain reason, or maybe you had a loan at work, you lost your job, so that IRA paid out. If you can get that money back into the IRA within 60 days, it's not taxable, but it's critical that you don't mess that up. That 60 days is it's a hard stop. You got to do that right. If you lost your job with a loan, there's some more technicalities there. We can probably cover that in a different video, but I wanted to make sure we're thinking about that 60 days. I know I helped somebody the other day that was going to take some money out because they were just in a pinch, and I made sure that he understood that I know you're in a pinch and you're having to do this. You don't want to. That's not your normal thing, but you've done it. If you can come up with that money in the next 60 days and pay it back, now it's just considered a rollover and it won't be taxable. But I have to double check this, but I'm pretty sure you're only allowed to do one of those per year. And it's and I believe it's a 12-month year, not a calendar year. You may need to double check that because I'm just talking off the top of my head, but I think that's right. Like I said, we're here at a tax conference, so there's so much stuff coming. So I'm just talking to you guys just like I would some friends that I'll talk to downstairs and we'll just discuss stuff. So I'm trying to bring this conference to you. Understand that because there's so much here, always verify the stuff that I'm talking to make sure it fits your situation. A little CYA for me, and really for you too. We want to make sure we have this right. So I'm gonna keep going, but just want to make sure we set that stage. I'm not reading off of books. I'm just talking to you just like I would another CPA downstairs. Okay, another one is a rollover. How's that go? It's the rollover business startup, and that's what they also call it ROBS for short. And what that is, and I just want to make sure you guys are aware of it, it's where you have your 401k plan. It happens quite often when somebody has left the corporate world. They've got a large amount of money in their 401. They want to start a business. They don't have any money other than what's in there. And so they use the money inside of that 401k to then start their business. And those are called ROBS, R-O-B-S. And they can be very, very helpful for somebody who's trying to make that step. Now, normally it's not suggested. I'll just be honest with you. Most small business ventures fail. And if you take your retirement and you put it into a business and fail, we can't get that back, especially if you're 50, 60 years old and you're trying this one last thing. We want to be smart. So I don't want people just running and doing these without at least weighing the cost. But maybe that's an option for you, especially if you have enough that we can pull some off and not jeopardize your family's future. But they can be really helpful, and I know a lot of people who've done them. Some have done them well, and unfortunately some haven't. So just want to let you know that. I don't know that I've ever talked about them. I try to avoid them in most cases, but since it came up today, I thought I'd go ahead and share that with you guys. Now, this was an interesting one, and I know this one is a mistake that a lot of people make. And that has to do with a loan on a house. So let's say mom and dad are trying to help their kid. That's the most common place I see it. And so they loan money to the child to buy a house. Nothing wrong with that. It's actually perfectly legal. They draw up the documents. They're charging interest rate. They think they're doing everything the right way. But there's been several court cases now that have come out. If you haven't secured the debt, so in other words, do you have a lien against the property? If you haven't done that, that could potentially fail. So you may be generating interest income to yourself, but the person you're trying to help actually may not have what the IRS would consider a legitimate mortgage and may not be able to deduct their interest. So it's something that could be easily overlooked. I know that I've had quite a few clients that have missed this one, and I thought I'd just go ahead and bring that out there. That's a pretty good one that's easy to make a mistake on. In the same vein with that, it's not something I've had to deal with a lot, but it is still out there. And if you were to go back to I believe it was about 98-ish, the rule used to be that if you bought another house, basically you bought a house. If you sold a house, and made a profit on it, you had to buy another house for at least as much as the one that you just sold, so you wouldn't have to recognize the gain. I believe, like I said, this is going way back, but I believe you had 3 years. If you didn't buy another house that cost more than the one you sold within 3 years, you were going to have to pay tax on that gain. Well, we've gotten a long ways away from that, and since then we had the rule that if you're married, you can make up to $500,000 tax-free, or if you're single, $250,000. The thing is, the last 5 years, the price of real estate has gone through the roof. So in Kansas City, there weren't a lot of people that had houses that cost more than $500,000, let alone had a gain of $500,000, so we didn't have to worry about it. Well, now the price of houses have gotten pretty crazy. And so if you're somebody who did that, 92, 93, 88, I don't know when you did it, but you bought a house and then you had a gain and you rolled it into that next house, and now you're thinking about selling, it's really important that we don't mess this up, because there could be a certain amount that needs to be taxed, and we haven't filed that form really much in the last 15 years, so we're not tracking it. You know, we only keep tax returns for 7 years, so we wouldn't even have it. So I want that to be on your mind. If you're somebody who's been in your house for a long time and you did one of those deals, make sure if you're about to sell, you call us and we talk through it, and we make sure that we're not overlooking some potential hidden taxes that you didn't even think about. Okay, moving right along. I don't think this one's gonna last as long as yesterday, but I'm gonna, like I said, just try to hit the high points for you guys. Itemized deductions. We've talked a lot about that. Most of you guys understand that. We've talked about it in the past about bunching deductions. So in other words, instead of giving your charitable deductions maybe steady throughout the year, maybe what you do is you hold back this year's donation and put it into next year's, or the other way. Maybe you push up next year's deduction and put it into this year's deduction. And the idea is that I'll take standard deduction this year and I will bunch and take itemized deduction next year. And we alternate back and forth. That way we're getting the most value for our itemized deductions. Same thing with Well, generally it's mostly that, because there's some court cases on the other stuff. So let's just keep it simple and go there. So I just wanted to bring that up. We've talked about it in the past. Donor advised funds, we hit that yesterday. But one thing that did come out of this is when you're giving non-cash donations, and I see this a lot, it's important that we document what we're giving. And it's also important that we have the receipts if we've paid for something that we're donating, just like it is. But what I always recommend, and I've said this a lot of times, is if you're giving clothes and household items, go ahead and stretch it out on the floor, take a picture of all of it, make sure it has a timestamp on it, and write down what everything is. And then you can go to the Salvation Army's website. They have a really good value guide. You can put that and log it all together. So then when it's time to do your tax return, you've got a nice clean log that's contemporaneous when we did the return. And that way later on, if the IRS challenges it, we've got the documentation. You also want to make sure you try to get that receipt from Goodwill or DAV or whoever you're doing it with, and if possible, have them sign off on it. That way we're trying to make sure we don't lose that deduction if we ever got an audit. But one I've seen missed a lot over the years, I mean not a lot, but multiple times, is when somebody gives a lot of stuff. The rules are, if you're donating more than $5,000, there has to be an appraisal. And so unfortunately, a lot of times people have donated a whole bunch of stuff, but they didn't have an appraisal on what they did, and they lost the deduction. I don't want that to be you guys, so that's why I'm telling you this now. If you're thinking about doing something like this, and it's a big ticket item, make sure we get that appraisal, because without that appraisal, we've got a problem, and the IRS will disallow it. So that's something to think about that maybe you hadn't. 2% itemized deductions. I get this every single year where people ask me, can I write off my home office? But they work for a company. So the answer is no, you cannot. Since 2018, with the Tax Cuts and Jobs Act, the 2% deductions went away. So that's things such as, well, tax prep fees, that is unreimbursed employee expenses. So maybe you're an over-the-road truck driver. All those things you used to could write off. The per diem, that's all gone. Same with a lot of contractors who may travel a lot and go work out in another city for 3, 4, 5 months. It can't be year round, but for short-term jobs. And we used to get that big deduction for per diem. We haven't had any of that since 2018. Same thing with the home office. If you're an employee, we cannot get a deduction for home office. You could potentially go to your employer and ask them to reimburse you. That way you could at least get some income for it, but that's still going to be income to you, and there is no deduction for home office. So I just want to cover that as an employee, not as a business owner, but as an employee. So I want to make sure that's clear. Another one we lost in that same act was the casualty loss. Used to, if a tree fell down and tore up your deck or window or holes in your roof, we could try to get a deduction for that. Unless it's a federally declared disaster area, that's not deductible. And that's a question I get every year. Same thing with theft losses. We're only going to be able to get that casualty loss in a federally declared disaster area. And in our part of the country, we don't have a lot of those up in the Kansas City area. But there's certain areas, I mean, we've seen it on the news, that's going to be a big deal for some. So if that's you, in your case, if you're in that area, it is going to be deductible. Make sure you work with your tax preparer to not miss that. We spent a lot of time on rentals today, and a lot of people don't realize this. They go and buy rental property, and they're taking a loss on it, and they don't understand that a passive activity loss, which is a rental property, cannot offset your ordinary income. Now, if you materially participate, which means you're involved in the rental and those kind of things, you can deduct up to $25,000 against your ordinary income as long as you don't make too much. Now, there are phase outs on that. I think it's about $150,000. If you make above that, you don't get any. They're not lost. They're just suspended until either you do have a profit or we sell the property. But a lot of times people buy rentals thinking they're going to get these losses against their other income, And that's not going to happen unless you become a real estate professional. And maybe we'll do a video on that another time, because there's a lot of nuances to that. We talked about that today, but that's a very specific thing. And maybe I can make a different video for you, because if you're going to be a real estate professional, maybe you can. And not maybe, you actually can. But we'll save that for a different video, because I don't want to bore everybody. Now, whether it's rentals, whether it's small business, whether it's the itemized deductions, this did come up multiple times today. And it's so important to have good documentation. That means the actual receipt. I don't know how many times I've dealt with somebody who's going into an audit and they thought because they put it on a credit card, that was a receipt and would count. It doesn't. And the argument's always, Doug, I got the credit card. It shows I went to Home Depot or Walmart or Lowe's or wherever, and I've had the expense. But the problem is we don't know what that expense was for. For example, if you went to Walmart, yeah, maybe you bought a new printer to do office work. Or maybe you bought a case of beer. We don't know. The credit card receipt in and of itself does not substantiate the expense. So you need to keep receipts. And I really want to say on this, get a scanner. You can buy scanners so cheap anymore that are good. The Epsons are good. The Fujitsus are good. Get a good one. You can put a stack of receipts for the whole month in there, and like that, scan them all in, and then you have them, because we know what happens with so many of these receipts. They're thermal. And when we go to get them out a year and a half from now, they're just a white sheet of paper. It's blank. And it's a horrible, horrible feeling if you're going through an audit and you've got all these white pages that used to say something and they don't. So that's a good tip right there. Documentation is king. Now, going back to what we talked about in one of my videos the other day was BOI. I'm not going to spend a lot of time on this because that video covers it pretty good. There wasn't much new, but there were a few things that I wanted to share with you that came out of today's class. I already told you about AICPA and other people that are trying to work on that, but there are a group of Republican senators trying to do that. There's also about 4 court cases currently working, is what we were told today, on this, trying to get it repealed or changed. We're gonna have to wait and see what happens. The truth is, for now, unless something happens quick, we're still gonna have to do that. And that's what came out of these classes. Will it change? Will it be different? Maybe, possibly, probably, we don't know, but we're gonna have to comply. There's good movement on it, so maybe it will be different, or at least where the penalties become reasonable, or the time to get it fixed if it's wrong will change. We just don't know. There was one court case, and I want to talk about this one, where they actually won and don't have to do it. You think, great, that means we're off the hook. Unfortunately, because of how this case went down, it's not for all of us. It's only applies to the people that were a member of that group. So that group got a pass. But that could be a good sign for the rest of us that maybe more is coming. But I don't want to get your hopes up. Right now, we only have about a month left, a little over a month to get these done. We can't wait till the last minute because the penalties, we've talked about them, are so staggering, it's not worth the chance. All right, moving right along, we talked about our ERC, and one of his big concerns was supply chain. I'm not going to spend much time on that because tomorrow we got something pretty exciting. We have a pretty big shot from the IRS is going to be here to talk to us tomorrow. A big thrust of that's going to be ERC, and we're going to talk to him about some other stuff. So I'll save that for tomorrow because I think there's going to be some really good information on how the IRS is viewing it, what their timelines are. Those are the kind of questions we're going to be asking. When do they, there's a lot. So I'm going to save that for tomorrow. If you're involved in that at all, I would definitely check out tomorrow's video. And like I said, we'll go with that tomorrow. Okay, wrapping it up here. One of the last things we talked about was the IRS Dirty Dozen. And that's just a list of things that the IRS says, hey, watch out for these. These tend to be scams, or there are things where they're just pushing the envelope and we're coming after them. So beware, don't get involved with people who are doing these things. But in amongst all that was all the phishing and the smishing and the spear phishing. The main thing there is just be so very careful about clicking on things. Everybody is out there. They want your information. They really like to take advantage of tax deadlines and tax season and other times like that to make it look like you're getting a legitimate request for information. They're trying to help you with a tax scenario, tax notices. The IRS doesn't work that way. Watch out for this stuff, and if in doubt, just don't click on it. If it says it's from somebody and you're not sure, verify. Don't just click on it, because that's what they're after. I don't know if you guys can hear that. There's airplanes in the background. We're close to the airport, basically just right off the runway. But anyway, I digress. Sorry about that. But be very, very careful. And on our end, we're the same way. So if you send us something and don't send it through the portal, I'm probably not going to open it. I may not even look at it, but if I do see it, I'm probably going to try to call you first and verify, because it's just too dangerous for us and it's too dangerous for you. And so please don't get upset, but we're just not going to be downloading your attachments. There was 3 different scenarios in the Dirty Dozen with the IRS that all related to this kind of a thing. So that's 25% of the problems out there are related to that stuff. We're not gonna do that, and I don't want you to either, so be careful and protect yourself. And then the last thing they talked about was crypto. We put videos out on that before. In a lot of ways, not much has changed on that, because we've had the same tax laws since mostly, I mean, there's some differences, mostly since 2018. There are some things out there, including a new form called a 1099. I believe it's going to be DA for digital assets. They delayed that, so we're probably not going to see that form for another year-ish. I'll keep you informed as that comes along. But there's a lot to that with the staking and everything else as far as when's it income, when's it not. But I believe I've covered that in another video, so I'm not going to go down that, because that's very specific and only relates to a few people. And so that's it. So today was pretty good. Tomorrow, once again, the highlight's going to be actual bigwig from the IRS here talking to us. A lot of that I think is going to be ERC, but we'll see what else he has to say. Last time he was with us, he also talked about all the new agents they've hired, when they think those are going to be actually ready to start doing things. And maybe we'll discuss audit rates. I don't really know what he's got planned, but I know we've got some questions we're wanting to ask, and so I want to bring you that tomorrow. We're also going to be talking about partnerships tomorrow, and then we'll also continue on the 1040 update. They will start getting more specific as we go through this week. So stay tuned, halfway there, and I hope you guys are finding this useful, and I'll see you guys when I return.